Well, we've heard from President Biden and the Fed this week while in the thick of earnings season. And of course, investors seem to be interpreting their messages as a sign of better days ahead. With the S&P, as we can see there, up about 7.66% year to date. The Nasdaq up about 14.33%, and the Dow there up about 3%. We're seeing that markets might be pricing in the end of the inflation problem, or could it be that investors just have a case of FOMO and are really getting in on the action now? Well, joining now to discuss is Hargreaves Senior Investment and Markets Analyst Susannah Streeter. Good to see you, Susannah. I mean, we saw some volatility creeping into that FOMO rally, but as we look, all three major indices still in positive territory, especially the Nasdaq. How would you characterize investor sentiment right now?
Yes, I think what's happening is that investors are clinging on to any hope that inflation really is coming down much more sharply. And that's when Jerome Powell talked about disinflationary forces taking hold. You saw recovery really on Wall Street yesterday. Now, there has been a bit of a decline so far in the session because, again, I think the focus has shifted a bit to his other comments where he said that actually the job was going to take quite some time, well into next year, really to see inflation perhaps falling back down to target. So there is still some concern about what this will mean for the US economy. If interest rates have to be hiked a little bit more and stay there perhaps for longer. So I think that's why you're seeing a little bit more weakness seep in today. But overall, I think it is a glass half full approach rather than glass half empty.
So then, do you think the markets are pricing in the right amount of risk, given that they're also digesting what they're seeing with earnings season? Some macroeconomic warnings still ahead in some of these earnings, but do you think they're pricing it incorrectly at this point?
It is extremely difficult to assess whether or not the pricing is absolutely on the ball right now, because of course the data does tend to change, surprise on the upside and surprise on the downside. For example, here in the UK, we've had data out, or at least a forecast anyway, from the National Institute of Economic and Social Research, estimating that the UK will avoid a recession, partly because we've seen inflation start to come down and consumer confidence and company confidence and optimism begin to creep up, creating this positive loop. Now, if this positive loop, of course, can continue, that certainly could help, because if people feel a bit more confident, they're much more willing to spend. And given just how reliant both the UK, the US economy and European economies are on consumer spending, a lot hinges on that.
So then, is it too soon to say whether or not we're in a bear market trap or in the next leg of a secular bull market, or perhaps a bit of touch and go and something in between?
I think it's real touch and go right now. Look, there are plenty of glimmers of hope on the horizon. We've had the reopening of China following those really drastic COVID restrictions, and infections are easing. That certainly helped lift confidence that demand will return there. We are over an energy shock, for now at least, in Europe, partly because of really high production from the energy giants. So in some ways, we're seeing updates from those giants coming through, BP and Equinor estimating that demand is going to be strong, and cash will be flowing in because, of course, gas is so valuable as we transition to renewables. You really do need it in the mix. And so that's likely to keep their profits certainly ticking over in a very buoyant fashion. I certainly think as though, at the moment, investors are reading more upside than downside right now. But still, let's remember, as I was indicating a little bit earlier, data does surprise on the downside and the upside. And as the central bank policymakers have said, they have to keep a really, really close watch on those readings, because if there's any hint that the inflationary spiral is proving a lot more sticky, and that means that interest rates will have to be ramped up even further, the worry will rise and resurge again that there could be harder landings for economies.
And we did hear, of course, from Atlanta Fed President Raphael Bostic that it could be another 25 basis point hike. It could be a pause. It could be a pause and then a hike, perhaps even up to 50 not being off the table as well. How, as an investor, do you really try and, I guess, protect yourself as best as possible, or really find the opportunities in this sort of touch and go environment?
Well, certainly, as always, it's ultra important right now that you're well diversified across sectors and geographical regions, of course, in such turbulent times, and across asset classes as well. That's, first of all. And certainly, I do think what investors are doing is not looking, backwards at what's happened. It's looking forward to try and get indicators about what will be ahead. And that certainly means reading all of this economic data and the predictions that we're getting from so many sources. But certainly diversification is absolutely crucial right now. And certainly, you've got to look at valuations, historic valuations, and there certainly could still be some resizing to come in terms of the tech giants. And I do think that there perhaps should be still a little bit more caution, particularly in that sector.
So not time to dive in quite yet. Still a lot more movement going on, as you were saying there. Hargreaves, Senior Investment and Markets Analyst, Susannah Streeter, thank you for joining me this morning.